Are you like many Americans and have asked yourself, is there a better way to save for retirement? If you have, stick around, watch the rest of this presentation, and you will find your answer. Let's start with a reality check. Are you like many Americans? Are you currently participating in a qualified plan where you pay the taxes later, but you get a write off today? When I'm talking about a retirement plan, I mean like your 401k or an IRA. Do you understand the four wealth eroders in a qualified plan? Those eroders are exposure to market losses, exposure to future tax increases, costly fees and expenses, limitations on liquidity. Let's talk about the history of qualified plans. Qualified plans, what are they? This is where an employee contributes to a savings account with pre-tax dollars. You're taxed at the time of distribution. That means when you take the money out. When you put the money in, you get to write that off as a write off on your taxes. The employer may match some or all of your contributions. Like IRAs and 401ks that were created by Congress in the 1970s, they were actually never designed to be a standalone retirement plan. At that time, most employers still offered what we call a defined benefit or pension plan, and Social Security was solvent. Wall Street loved the qualified plan. Why? Because it opened up a huge opportunity to sell mutual funds to middle America. Employers literally let the mutual fund companies in Wall Street in the front door to sell to their employees. It was supported and reinforced with multi-billion-dollar ads. Qualified plans were a huge win for employers. Why? Because it got them out of paying for your defined benefit or pension. It saved them billions of dollars a year in trying to take care of the employee. It allowed them to shift the risk from themselves to the employee. Now, today, only about 11% of private employers offer a defined benefit or pension plan. The four wealth eroders, we're going to talk about these in more detail as we go along, but I just want to expose them for who they are. Number one is market losses. Number two, it's future tax increases. Number three, it's costly fees and expenses. And number four is liquidity penalties. Now, the first one, exposure to market losses. Everybody knows who Warren Buffett is. So he's going to give you two rules to think about. Rule number one, never lose money. Rule number two, never forget rule number one. Now that comes from one of the most wealthiest people in the world. Are you following those rules? Exposure to the market continues with since 2000, the S&P has had 2 years of declines greater than 20%. If we go back to the 1900s, history suggests we can expect a market correction or a decline of at least 10% once every 3 or 4 years. History also suggests the market is nearly impossible to time consistently. Now, market losses aren't easy to recover from. If you take a look at this chart, it's pretty simple. If you start with $100 and you go down 10%, you're at $60. But in order for you to get back to 100, you need to earn 66.6% return on the $60 that you had in order to turn it back to 100. But let's say we look at this from another angle. You start with $100, you go down 40%, you end up at $60, but you only earn a 40% return on your $60. You end up with $84 left, which is a net loss of 16%. Now, I'm going to ask you guys, if you were to take a loss in your current retirement account, would you be able to make the money back? Exposure to future tax increases. One primary advantage of qualified plans is tax deferral. That means you don't have to pay the taxes now, you pay them later in the future. Reality check though. Right now, statutory rates are historically low. For many families, the common saying that you'll have a lower tax rate in retirement is a myth. You're deferring taxes, but you may be deferring them to a future time when you must pay a higher rate. To continue on, no one knows for sure what future tax rates will be. Here's what we do know though. Right now, tax rates are historically low. Our government is spending more money than it makes or takes in, and common sense says that the current state of affairs is not sustainable in the long run for the US government. The case against your tax bracket decreasing in retirement. Many of your deductions go away. Your mortgage interest on personal residence, that's gone because your house is fully paid off. Your children, both deductions and credits, they're gone because your children are out of the house. We're calling you empty nesters now. And qualified plan contributions, you no longer are contributing to a qualified plan. So, all the things that you were using when you were working to reduce your taxes no longer work in your benefit when you're not working to reduce your taxes. So, therefore, you will pay a higher rate of taxes than you did when you were working. Here's a chart that shows what the historical tax rates have been since 1913 to at least 2013. Now, as we know today, taxes are still at the highest at 39.9 is our highest tax bracket. But if you look back over the past, the highest tax bracket was some 99, 90, about 95%. As you can look, and there's been times where it stayed pretty steady at that number and dropped down very slightly. But if you look back at the years for the government, we were in less debt at those times than we are currently now when taxes are lower, guys. Costly fees and expenses. This is one of the other eroders that many people do not even understand or know. So, most people don't know what their qualified plan costs them. 50% of the people have no idea what the fees are they're paying. 40% think they don't pay any fees at all. But research indicates the average plan costs 1.4% in fees and expenses. If you have an actively managed funds, you can add another 2% or more to that. So that would bring your total fees and expenses can be about 3 or more out of your current returns. Liquidity penalties. Now, this is one that we have seen a great deal of in the past, but we were lucky in 2020 because of COVID, because the federal government allowed us to not have to pay this penalty to get into our retirement account. But what this is withdrawals from your qualified plan prior to the age of 59 and a half are subject to a 10% penalty. That's apart from normal income taxes owed on the distribution. Life happens. Even for emergencies, you still have to pay a penalty to access your money. If you lose your job, if you need to pay a kid's education, if you want to start a business, if you want to retire early. Americans pay billions a year in penalties to use their own hard earned money. Why do you want to pay to use your own money? Why should you be forced to pay to use your own money? That should be the real question you ask yourself. Now, there is a better way to save for retirement, and it's called an index universal life insurance policy. It avoids and or minimizes the full wealth eroders, which are exposure to the market, exposure to future tax increases, costly fees and expenses, liquidity penalties, But one bonus that it does provide is it comes with permanent death benefit. So your plan self-complete if you die early or prematurely. Universal life. It's flexible. It says adjustable premium life insurance policy. Every month, the cost of the insurance and the policy costs are deducted. The rest goes into what we call an interest earning cash accumulation account. So if you look at that, you got the pile of money in the middle. You take a part of it, you put it into the insurance's hand for to pay the fees and the cost of the insurance, and you take the other part and you put it in the big bucket, which we call the cash accumulation. Index Universal Life, also known as an IUL. The Index Universal Life, the options are having interest credited based upon an external market index, such as the S&P 500. Your gains are protected. You can never lose the principal due to a market downturn. If the index goes up, your account grows by that percentage based on any account caps that there might be out there. If the index goes down, your account has a guaranteed floor of at least 0.75 to 2%, depending on your account setup. Your account will always grow and never decrease. How do insurance companies offer this? Well, they achieve it through safe hedging strategies. The IUL is a viable alternative to a qualified plan. An IUL can potentially grow cash that can be accessed via policy loans. In the effect, you create a tax-free cash flow for life. It addresses the four wealthy rotors of market losses because you can't take any, higher taxes because you don't pay any taxes, costly fees and expenses because they're minimized, and the lack of liquidity because you have access to the money anytime you want. And the bonus benefit is permanent death benefit. So even if you die early, your loved ones will get a check tax free. Now, how does it address exposure to the market? This one is simple. You will never lose money in an IUL because of the declines in the market index. All gains are locked in via an annual reset feature. What does this look like? Well, the cash account in the IUL, which will be the blue line, increases when the index increases, but does not decrease even when the market declines, which is the red line. Your account growth is always locked in. So if you look at this, the blue line and the red line start out together. The red line goes up slightly, the blue line goes up also. The red line goes down, the blue line stays flat. The red line goes down again, red line stays flat. Red line goes down even further, the red line stays flat. And as you see, as the red line continues to pick up, the blue line picks up. And if you look at the further end, you see one that says it's at 182,116 and the other one's at 303,976. Red line being the S&P 500, blue line being the IUL. Guys, if I asked you right now, which line would you want? Most of you are going to say the blue line. But in reality, you all have the red line. Would you rather pay taxes on the seed or the harvest? That's a great question. It's always important to understand that. Because remember, we said this IUL will address future tax increases. The premium payments are made with after-tax dollars. So pretty simple. When and if you access your money via policy loans or withdrawals, you're not taxed on the gains and you're never taxed on the money at all. Addressing fees and expenses. You will have fees and expenses in an IUL. And IUL expenses are clearly itemized in your annualized statement. One of the biggest costs of insurance is nevertheless quite useful. It's what creates your permanent death benefit. Even considering the cost of insurance over the long haul, an IUL can often be a lower cost retirement saving option. An IUL will address liquidity penalties. You can access the money anytime you want without penalty. You don't need to wait till you're 59 and a half. Best of all, there is no restrictions on what you can use your money for. Bonus benefit, the permanent death benefit. How much is a 401k worth that you plan to put a bunch of money into over the next 40 years if you die in an accident next month? How about the worth of the guaranteed permanent death benefit provided by an IUL? There are also many other applications for IULs beyond retirement savings. You can use it for leveraging flexible policy chassis. You can use it to leverage the tax advantage status of life insurance. So you may ask yourself, what's the catch? Well, there really isn't a catch other than this. An IUL is a long-term commitment and you should have a long-term planning horizon. Of course, participating in a qualified plan like a 401k or an IRA is also a long-term commitment, even though many people don't think twice before enrolling in either one of those plans. There are several moving parts in the IUL policy, and many companies are offering them. Work with an advisor and licensed agent that specializes in IUL and knows how to properly structure the policy for your best results. You may be asking yourself right now, is an IUL right for you? Everyone's situations, needs, goals are different. The only way to know if this may be right for you is to talk to us and find out if it's a good fit for your financial goals and plans.